Welcome to this explainer. Today, we're putting on our sell-side equity analyst hats to perform a really rigorous, systematic valuation of Blaize Holdings, ticker symbol BZAI. We're going to rely strictly on the cold, hard data from their latest financial filings to try and pin down the true intrinsic value of this stock. So, grab your calculators because this is going to be a fascinating teardown. We're looking at a company whose valuation absolutely defies standard logic. We'll be testing the whole shebang, from discounted cash flow and adjusted present value all the way to sum of the parts and liquidation metrics.
All right, let's just dive right in. Look at this. We are immediately confronted with a staggering metric right out of the gate, a net profit margin of negative 4,200%. I mean, wow. In practical terms, this means for every single dollar of revenue Blaize brings in the door, they are losing $42. In all my time looking at balance sheets, numbers like this always demand an immediate deep dive investigation. A margin profile this deeply underwater tells us that the core business model is either in an extremely nascent build-out phase or, well, it's just fundamentally broken.
And that brings us to the core paradox we're investigating today. On one hand, you've got trailing 12-month revenue sitting at just $38.6 million. On the other hand, the company is burning through nearly $207 million in net income. Yet, and here's the kicker, despite this massive crater, Blaize Holdings still commands a market capitalization of almost $186 million. How on earth is the market justifying this? What exactly are investors paying a premium for when the actual reported earnings are, frankly, this severely negative?
So to solve this mystery, we're going to systematically walk through our valuation models. We'll start with the Blaize Holdings paradox, check out their liquidity and cash burn, analyze exactly why traditional valuation fails here, test out alternative valuation models, and wrap it all up with the analyst's final verdict. Starting with part 1, the Blaize Holdings paradox. Let's map out our required analytical methodology to see if that $186 million market cap actually holds any water. You see, as strict fundamental analysts, our documented procedure requires us to follow a very specific path. It removes emotion and bias, right? Step 1 is attempting absolute valuations, things like discounted cash flow, dividend discount, residual income, and adjusted present value. If those fail, because the data just isn't there, we move to step 2, a sum of the parts analysis to hunt for hidden divisional value. And if we still can't find intrinsic value, we move to step 3, which is looking at relative market multiples and asset-based liquidation comparisons. It's a rigid framework, but it's designed to uncover the absolute financial truth. Moving on to part 2, liquidity and cash burn. Look, before we run any complex valuation models, we got to assess the patient's vitals. We need to ensure Blaize Holdings has the liquidity to even survive our forecast period without going into immediate distress.
Surprisingly enough, the balance sheet isn't immediately drowning in debt. A debt-to-equity ratio of just 0.04 and a current ratio of 2.23 suggests they actually do have the short-term liquidity to operate right now. Their current assets comfortably cover those near-term liabilities. Plus, they're backed by a shockingly healthy gross margin of 49.22%. So on paper, the immediate vitals look stable. It means they can at least manufacture their product or deliver their service at a basic profit before the operating expenses kick in.
But that liquidity is draining fast. Trailing free cash flow is sitting at a highly negative $66.3 million. Basically, the cash they have on hand is being aggressively consumed by their daily operations and capital expenditures. As an analyst, when I see this, I immediately start calculating their runway, like how long before they're forced to dilute shareholders by issuing more stock, or worse, raise capital through toxic debt. A good current ratio only buys you time. It definitely doesn't fix a structural cash bleed. Which leads us to part 3, why traditional valuation fails. This severe cash burn brings us straight to our first set of required methodologies, absolute valuation models, and exactly why they completely break down here.
Our primary tool is usually the discounted cash flow, or DCF model. A standard DCF requires us to derive unlevered free cash flows from the documents. Project those positive cash flows out over a, say, 5 to 10 year forecast period. Apply a sensible terminal growth rate, usually assumed at 2 to 3% for a mature company, and then discount all that back to present value using the weighted average cost of capital. We'd also typically run an adjusted present value, or APV model alongside this, just to value the tax shields from debt separately.
But here's the problem. Because BZAI has deeply negative free cash flow, negative EPS, and a massive negative 374% return on invested capital,
We literally cannot derive a reliable cost of capital or mathematically project positive future cash flows. I mean, to force a DCF to work here, we'd have to aggressively invent some miraculous hockey stick turnaround scenario out of thin air. And as rigorous analysts relying only on the filings, we absolutely refuse to make those entirely subjective leaps. Therefore, both the DCF and adjusted present value models are structurally rejected by the data. They just don't work here.
So, moving down our analyst checklist to the dividend discount model and residual income models, we hit a similar brick wall. These models require either a consistent, stated dividend policy or excess returns generated over the required cost of equity.
And we have to explicitly note from the filings that BZAI has a 0% dividend growth rate and a profoundly negative return on equity of negative 530.5%. That means there's no consistent dividend policy to discount, period. Furthermore, with an ROE that deeply negative, they're actively destroying shareholder equity rather than creating residual income to add back to the book value. So these absolute models, officially off the table.
Next up, we attempt step 2, a sum of the parts or SOTP valuation. We do this to see if there are any hidden gems within separate operating divisions. Sometimes a parent company is burning cash, but one specific segment is actually highly profitable. By valuing segments independently and adding them together, adjusting for corporate overhead, we might just justify that $186 million market cap.
Unfortunately, the uploaded financial filings do not contain sufficient granular segment data to split the company into distinct risk profiles. Without separate cash flow, revenue, or margin data for different divisions, we're flying completely blind. We can't accurately price the risk of their different operations, so we have to skip the sum of the parts model entirely.
All right, part 4, alternative valuation models. With absolute models breaking down and SOTP missing data, a professional analyst must pivot to step 3. We're looking at relative and asset-based valuation frameworks. We have to figure out what the market is willing to pay compared to peers, and what the physical company itself is actually worth.
Looking directly at our relative valuation table, built from the data, trailing price to earnings is negative 0.86, and enterprise value to EBITDA is negative 2.11. Because both are negative, they are entirely unusable for peer comparison. This leaves enterprise value to sales at 3.67 as literally the only functional multiple we could possibly use against an externally assumed peer group of speculative tech companies. But hey, a word of professional warning here. Relying purely on a sales multiple when net margins are negative 4,200% is incredibly dangerous. It's like paying a premium for a machine that actively incinerates capital with every sale it makes.
So if we can't find value in earnings or safe comparable multiples, we have to try and find a hard floor for the stock using net asset value. This is essentially a liquidation value. We look directly to the balance sheet to restate the assets to fair market value and subtract all liabilities. The idea is, if the business shut down today and sold off all its parts, what would the equity holders actually get?
Well, the filings show BZAI is currently trading at a price-to-book ratio of 5.85. This means the market is already pricing the stock at nearly 6 times the accounting value of its net assets. Enterprise value to assets is also sitting up at 1.39. The big takeaway here is absolutely crucial. There is zero margin of safety on an asset basis. You are paying a massive speculative premium for physical and intangible assets that are tied up in a severely cash-burning operation. Finally, part 5, the analyst's final verdict. Let's bring all this analytical rigor together into a single conclusion. What is the final prognosis for this highly distressed stock? Well, the market has clearly started recognizing these fundamental flaws and has severely punished the cash burn. Yearly returns dropped aggressively from a positive 39.8% in 2024 to a crushing negative 87% in 2025. And that downward momentum? It's continued into 2026 with a negative 4.1% return, dragging the current share price all the way down to just $1.87. The wider market is definitely waking up to the math we just mapped out. Given that traditional absolute models yield zero intrinsic value based strictly on current filings, the segment data is missing for a parts analysis, and the stock trades at a stark premium to its hard assets while burning over $66 million a year, you really have to ask yourself a serious question. Are you investing in a fundamental, evidence-based turnaround, or are you just catching a falling knife? Based on the cold, hard math from their own filings, the fundamental value just isn't there yet. Thank you for joining me on this explainer. I highly recommend digging into these filings yourself to see the true story the numbers are telling.
But what do you think? Does the promise of future tech outweigh a balance sheet on fire?